Most professionals sit in meetings where someone mentions a balance sheet number and they nod. Not because they understand it, but because admitting they don't feels risky. The problem isn't intelligence or maths ability. It's that no one ever taught the four numbers that actually matter. This tutorial covers the complete architecture of a balance sheet, the four ratios that do most of the analytical work, and the three places companies hide inconvenient truths. No accounting degree required. By the end of this, you'll have the tools to ask one uncomfortable question at the right moment and know exactly why it matters. Balance sheets aren't only for investors. If you're evaluating a job offer, the company's balance sheet tells you whether your future pay increase is already preempted by debt servicing costs. If you're signing a vendor contract, it tells you whether that supplier can survive a difficult quarter. If you sit in any meeting where financial decisions get discussed, you either contribute to those conversations or you spectate. Financial fluency doesn't require becoming your own CFO. It requires knowing enough to ask one question that nobody else in the room thought to ask, and having the evidence to back it up. The assumption most people carry is that financial statements are built for accountants, and that understanding them requires training most people never received. This is precisely backwards. Balance sheets are designed to answer a specific, answerable question for anyone who reads them. Can this organization survive what's coming? The reason people feel confused isn't that the subject is technically difficult. It's that the standard presentation buries the four numbers that matter under 40 numbers that don't, and most readers give up before they find the signal underneath the noise. The goal today is to cut straight to those four numbers. A balance sheet has three sections. Assets, what the company owns or is owed. Liabilities, what it owes to others. And equity, sometimes called shareholders' equity or net worth, what's left over after you subtract liabilities from assets. That's the entire structure. Every number in every annual report, from a startup raising its first round to a multinational filing its 100th, fits into one of those three buckets. The fundamental accounting rule is assets equal liabilities plus equity. Think of it as a weighted scale. Both sides must always balance. If they don't, something in the document is wrong. Assets are divided into two categories based on how quickly they can be converted to cash. Current assets are liquid within the next 12 months. Cash itself, accounts receivable, which is money customers owe but haven't yet paid, and inventory held for sale. Non-current assets are the long-term holdings, property, equipment, patents, and goodwill from acquisitions. The reason this time distinction matters is liquidity, whether the company can access its assets quickly enough to meet obligations when they come due. A company can have millions in assets on paper and still run into trouble if none of those assets are accessible in the short term. Liabilities follow exactly the same time logic as assets. Current liabilities are obligations due within the next year. Accounts payable to suppliers, short-term debt, deferred revenue from customers who paid up front for services not yet delivered. Non-current liabilities are the longer horizon obligations, long-term bonds, pension commitments, lease arrangements. Here's why this architecture matters in practice. A company can be reporting profit every single quarter and still run out of cash because its short-term liabilities are growing faster than its short-term assets. Enron was technically profitable. Lehman Brothers appeared solvent a week before its collapse. Both were managing this time dimension and losing. Equity is the residual, what's left for shareholders after every obligation has been accounted for. The formula is straightforward. Equity equals assets minus liabilities. If assets exceed all the debts, equity is positive and shareholders own real value. If liabilities exceed assets, equity turns negative, which means creditors effectively own the enterprise, not shareholders. Equity grows when a company retains earnings rather than distributing them as dividends. It shrinks when losses accumulate or when the company buys back shares at a premium to book value. Tracking equity across 3 consecutive years often tells a cleaner, more honest story than the income statement does. The accounting equation, assets equal liabilities plus equity, isn't a rule someone invented to make balance sheets more complicated. It's a structural truth that reflects how every business transaction works. Every transaction affects at least 2 parts of this equation simultaneously, and the 2 sides always balance. When a company borrows money, cash assets increase and liabilities increase by the same amount. When it repays the loan, both decrease equally. This double-entry logic is why the document is called a balance sheet. If you encounter one where the 2 sides don't match, stop reading and ask a pointed question. Something in the preparation went wrong. The first ratio worth learning is the current ratio. Take the current assets, divide them by the current liabilities, and you get a single number that tells you whether the company can pay its bills in the next 12 months. A ratio above 1.5 is generally considered comfortable. It means for every pound or dollar owed in the short term, there's at least 1.5 in accessible assets. A ratio below 1.0 means the company owes more in the near term than it can currently reach. That's not automatically fatal. Many companies operate this way deliberately, but it's a question that demands a clear answer. Both extremes of the current ratio signal something worth examining. A ratio below 1.0 means the company is structurally reliant on either rolling over short-term debt or generating enough operating cash to close the gap, which works until it doesn't. The week Lehman Brothers collapsed, its current ratio looked manageable on the surface. The problem lived in what the short-term liabilities were backed by. A ratio above 3 or 4 carries its own question. A company sitting on that much liquid cushion relative to obligations may be conserving capital for an acquisition or a downturn, but it may also signal management has no productive use for the cash it's generating. Neither extreme is automatically good or bad. The debt-to-equity ratio takes total liabilities and divides them by shareholders' equity. This tells you how leveraged the operation is, how much of its activity is funded by borrowed money versus by what shareholders actually own. A ratio of 1.0 means equal parts debt and equity. Think of it like buying a house. If you put down 50% and borrow the other 50%, your personal debt-to-equity ratio is 1.0. Higher leverage isn't automatically reckless. It depends entirely on how predictable the cash flows are. But the ratio tells you immediately how much financial cushion the company has if revenue drops. Less equity means less margin for error. This is the point where most introductory finance content stops too early, and precision matters here. The same debt-to-equity ratio means entirely different things in different industries. Real estate and infrastructure companies routinely carry high leverage. Banks are comfortable lending against stable, regulated cash flows. A consumer goods company with high leverage during a commodity price spike is a different conversation. A software business with no physical assets and high leverage has very little collateral if revenue declines. Always compare a company's ratio to its industry benchmark, not to a universal standard. The question isn't, is this number high? It's, is this number high relative to what this type of business typically carries? Book value per share takes total equity and divides it by the number of shares outstanding. The result is what each share would theoretically be worth if the company stopped operating today and liquidated all its assets at the values the accountants recorded. Markets rarely trade at book value because they're pricing future earnings, not historical cost. But the comparison, what you're paying per share divided by the book value per share, is one of the oldest signals in value investing. This is the price-to-book ratio. When a company trades significantly below book value, the market is communicating that it doesn't trust the numbers on the balance sheet. Sometimes the market is right. The evidence usually sits in the footnotes. One balance sheet tells you where the company stands today. 3 years of balance sheets tell you where it's actually going, and the direction of movement is consistently more informative than any individual data point. Is the cash balance growing or shrinking year over year? Is long-term debt increasing while equity stays flat, which means leverage is expanding without retained earnings growth to offset it? Are accounts receivable growing faster than revenue? That last signal is subtle but important. It can mean the company is booking sales it hasn't collected, which inflates reported revenue without producing real cash. The trend is the fourth ratio, and in many cases it's the most honest one. Goodwill is the most common place where balance sheets obscure reality, legally and with full disclosure. When Company A acquires Company B for more than the book value of its assets, the excess gets recorded on the balance sheet as an intangible asset called goodwill. The rationale is that the premium paid represents something real, brand value, customer relationships, management talent. Sometimes it does. Sometimes it represents an acquisition premium the acquirer overpaid and will eventually have to write down. When a write-down happens, equity falls directly. The diagnostic question when you see a balance sheet heavy with goodwill relative to total assets. What happens to this company's equity if a significant portion of that goodwill gets impaired? Operating leases, certain pension obligations, and liabilities contingent on ongoing legal proceedings don't always appear clearly on the face of the balance sheet. They live in the footnotes, pages of dense disclosure that most readers skip because they're already looking at the headline numbers. This is precisely how companies can appear less leveraged than they actually are. The 2007 financial crisis included entire classes of obligations that major banks had carefully structured to sit off their official balance sheets. The legal obligations were still real. The footnotes had told that story for years before the collapse, in dense, technical language that required patience to read. Reading footnotes isn't glamorous. It eliminates most of the analytical risk that headline reading misses. Companies that hold physical inventory have a choice in how they account for the cost of goods sold. The two main methods are called FIFO, first in, first out, and LIFO, last in, first out. Think of it this way. If you purchased inventory at different prices over time, which batch do you assume you sold first? The accounting choice doesn't change the physical reality of what moved off the shelf. But during periods of inflation, the method you choose can shift the reported profit figure by double digits, legally, disclosed in footnotes, and routinely missed by anyone reading only the summary numbers. Same products, same sales volume. Materially different reported results depending purely on the accounting election. When evaluating a potential employer, pull the most recent balance sheet. It's public for listed companies and available for many private ones through Companies House in the UK or equivalent registries. Look at the current ratio and the trend in cash balance over 3 years. A company where the current ratio is declining and cash is shrinking is a company whose financial headroom is compressing. That compression flows through to hiring freezes, deferred salary reviews, and restructuring. Your negotiating position in a future pay discussion is directly connected to those numbers. A business servicing heavy debt obligations has already decided where the cash is going. Your raise competes with that cue. When evaluating a vendor or key business partner, focus on the debt-to-equity ratio. A highly leveraged counterparty can absorb a strong quarter perfectly well, but a difficult quarter can trigger restructuring, renegotiation, or collapse. Your contract doesn't protect you from a counterparty that simply cannot honor its commitments. For investment decisions, add the price-to-book comparison and calculate goodwill as a percentage of total assets. Then read the footnotes on off-balance sheet liabilities and inventory accounting elections. That last step takes approximately 20 minutes and eliminates the majority of risks that analysis limited to headline numbers consistently misses. It's the step that separates thorough from superficial. The full article at realsyllabus.com walks through every concept covered in this tutorial. The 3-section architecture, the 4 ratios, the 3 places balance sheets hide inconvenient truths, and exactly how to apply all of it when you're evaluating an employer, a vendor, or a potential investment. Real Syllabus publishes the education the system never delivered, not just financial literacy, but employment contracts, corporate navigation, and the real mechanics of professional life. If this tutorial was useful, the article goes further and gives you the framework in a single readable reference. The link is in the video description and in bio.